Welcome to vTalkInsight, Allocator's Lens Daily for March 2nd, 2026. Cross-asset positioning is being pulled in two directions right now, with private credit stress and Iran tensions driving a renewed flight to safety, even as the global earnings and AI stories stay remarkably strong. Let's start with equities, where the rotation away from concentrated U.S. growth leadership is colliding with these macro and geopolitical shocks. In equities, the headline picture looks fragile, but the leadership story is changing in important ways. U.S. benchmarks have just delivered their weakest month since the spring of last year, with broad indices down and volatility edging back toward the high teens and low 20s, signaling a clear risk-off tone. Yet under the surface, market breadth has improved sharply, and that matters for allocators thinking about where equity risk is actually working. Equal-weighted U.S. indices have outpaced the traditional cap-weighted benchmarks, even closing at fresh highs, which tells you mid and smaller names are carrying more of the load. Since late autumn, value and momentum factors have materially outperformed, with value up well into the double digits and momentum also solidly positive, while the most expensive growth stocks lag. Flows are shifting away from highly concentrated positions in mega-cap technology and toward broader index exposure and international markets, reflecting reduced conviction in a narrow AI and software-led story. Outside the United States, the equity picture looks considerably brighter. Global indices, excluding major U.S. benchmarks, have pushed to new highs, helped by earnings growth that is running roughly twice the pace of the U.S. while trading on lower valuation multiples. Europe and Japan stand out. European banks, industrials, and defense names are enjoying fiscal support and earnings upgrades, while Japanese industrials benefit from political stability, targeted stimulus, and more benign trade frictions. Across Asia, manufacturing-heavy markets such as Korea and Taiwan are seeing strong performance, especially in semiconductors and AI-linked hardware, and the broader Asia-Pacific Index is tracking one of its best February performances in decades. Sector leadership inside technology is also rotating. Semiconductors have become more volatile after a spectacular run, and there's growing debate over whether the current AI chip cycle is a one-off build or the start of a decade-long trend for names like NVIDIA. At the same time, asset-heavy infrastructure and data center plays are seeing powerful tailwinds. Data center returns are up strongly this year. Dell is guiding to tens of billions of dollars in AI server revenue with a record backlog, and large acquisitions in Nordic data centers highlight continued demand from both enterprises and hyperscalers. By contrast, asset-light software and parts of the megacap complex are experiencing price-to-earnings compression as free cash flow is reinvested into AI, raising questions about how long prior valuation premiums can be sustained. On top of that, there is a looming supply story with a sizable pipeline of potential initial public offerings, including high-profile issuers that could absorb substantial equity demand if they come to market. That reverses years of net equity shrinkage and could become an overhang for valuations if demand does not keep pace. AI remains the macro theme tying this together, but sentiment is more two-sided than earlier in the year. There is still strong conviction in the growth outlook, with revenue for leading AI companies projected to multiply over the coming years and major funding commitments from large technology and investment firms. Yet investors are increasingly focused on potential losers, from disrupted software models to labor market dislocation, and are diversifying away from the narrowest AI winners toward real assets and international cyclicals. For equity allocators, the key watch points now are how upcoming inflation data, private credit headlines, and any escalation in the Middle East feed back into this rotation between regions, sectors, and factors. Turning to rates, government bonds have reasserted their role at the heart of multi-asset portfolios. The U.S. 10-year yield has dropped below 4% after roughly a quarter-point move lower, giving Treasuries their strongest monthly performance in about a year. This is being driven by a pronounced flight to safety as stress builds in parts of the financial system and geopolitical risk around Iran rises. Curve flattening and the simultaneous decline in small-cap equities hint that bond markets are skeptical about the strength of the growth narrative, especially with personal incomes stagnating and households increasingly dipping into savings. The challenge for rate setters is that the inflation data have not fully cooperated with the bond rally. Producer price inflation surprised to the upside, with core measures picking up and pointing to a personal consumption expenditures deflator that could print at levels not seen since early last year, likely pushing core inflation back above 3%. Components such as portfolio management fees, airfares, and rising input costs for electronics and memory chips all add to near-term price pressure. That combination complicates the Federal Reserve's path, undermining expectations for early or aggressive rate cuts, even as markets increasingly believe that incoming economic data will matter more than cautious central bank rhetoric. At the same time, there is a medium-term disinflation narrative building around AI and the labor market. Rapid automation is shifting bargaining power toward employers, restraining wage growth, and contributing to softer underlying inflation in some sectors, while AI-driven efficiencies threaten to commoditize parts of the software and services stack. These forces support the idea that inflation can remain contained over the cycle, which helps justify lower-term premia despite today's noisy data. Globally, policy is diverging. The Bank of England is expected to cut twice this year as UK fiscal headroom improves, while in the euro area, a hotter French inflation print nudged yields higher, but is not seen as a game-changer for the European Central Bank. For allocators, the key question is whether treasuries can continue to offer both attractive income, especially in the short and intermediate maturities, and a genuine hedge if equity and credit volatility were to intensify further. Credit is where many of today's cross-asset fault lines are most visible. In public markets, investment grade and high-yield spreads have widened to their highest levels since late last year and are now at year-to-date wides for several segments. This spread widening has occurred alongside strong demand for treasuries, underscoring a clear risk-off shift and a growing preference for liquidity. Some observers frame this as an ongoing repricing of risk rather than a completed adjustment, which implies a non-trivial chance of further volatility as the process plays out. Conditions are more acute in private credit, especially in direct lending to software and real estate-related borrowers. Several large funds have cut dividends and marked down portfolios as loan defaults tick higher and lower benchmark rates compress the income they earn on floating-rate assets. There are mounting signs of liquidity strain, with redemption pressures in listed vehicles, restrictions on withdrawals at some managers, and retail investors discovering that these products are far less liquid than they had assumed. In Europe, accounting rules that allow delayed recognition of losses risk masking underlying problems and increasing the likelihood of sudden adjustments when issues finally surface. Specific blow-ups have sharpened market focus. The collapse of a UK non-bank lender has revealed instances of repeatedly pledged collateral and alleged misdirected funds, hurting the share prices of banks and asset managers exposed to its loans and reminding investors how fraud risk tends to rise late in the credit cycle. The broader banking sector has sold off, with bank indices down sharply as concerns grow over links between private credit and the regulated system, including expectations that defaults in software-focused private portfolios could reach mid-teens percentages. Against that backdrop, some argue that corporate fundamentals and liquid credit, particularly in Europe and parts of emerging markets, remain sound and that yields across fixed income look the most compelling in years. But dispersion is increasing, making security selection and an explicit view on liquidity risk central to any credit allocation. For multi-asset allocators, developments in private credit are now a key early warning indicator for equity volatility and a major driver of the renewed demand for government bonds and even precious metals. In foreign exchange, the dollar's role at the core of the system looks intact despite repeated talk of de-dollarization. Over the past year, foreign investors have increased their holdings of U.S. treasuries by hundreds of billions of dollars, even as headlines focus on diversification away from U.S. assets. Some of the apparent reduction in holdings by countries, such as China, reflects securities being parked in third-party custodial accounts rather than genuine selling. At the same time, structural constraints limit the ability of alternatives to fill the gap. The euro suffers from fragmented financial architecture and political divisions, while the renminbi is held back by capital controls and questions over institutional trust. Near-term, geopolitical tension and credit stress tend to reinforce the dollar's safe haven bid, particularly when they coincide with softer equity markets and strong demand for treasuries. Regional data do matter at the margin. A stronger-than-expected inflation print in France briefly supported the euro and nudged local yields higher, and expectations for Bank of England rate cuts alongside rising political fragmentation in the UK create a nuanced backdrop for sterling. In emerging markets, a structural turnaround supported by AI adoption, improved governance, and higher research and development investment is underway, helped by periods of dollar softness. But that constructive story remains sensitive to any renewed bout of broad-based dollar strength if risk aversion were to deepen. For allocators, FX remains both a transmission channel for global shocks and an important lever for expressing views on the balance between U.S. safety and non-U.S. growth. Commodities round out the cross-asset picture, with oil and gold acting as key barometers of how seriously markets take the current geopolitical and financial risks. On the energy side, tensions between the United States and Iran have escalated, with significant U.S. military assets deployed in the region and nuclear talks stalling. Crude prices have risen on the headlines, but they remain below the peaks seen in late 2023, suggesting that markets still assign a relatively low probability to a prolonged disruption. The critical variable is the Strait of Hormuz, through which a large share of global oil supply flows. A closure in retaliation for military action could take a substantial portion of world supply offline, far beyond what OPEC Plus could realistically offset, posing serious downside risks to global growth and upside risks to inflation. Precious metals tell a slightly different story. Inflows into gold and silver exchange-traded funds have picked up, reflecting investor demand for insurance against both geopolitical shocks and financial sector stress, particularly around private credit and banking linkages. In Europe, basic resources and gold-related equities are outperforming more traditional defensive sectors like utilities, pointing to a rotation toward real assets that can benefit from higher commodity prices and from the long-term themes of electrification and AI infrastructure build-out. For allocators, the key is that while oil is only partially pricing Iran-related tail risks, gold appears to be capturing a broader desire for protection against low-probability but high-impact outcomes that span inflation, growth, and financial stability. How those two markets evolve from here will be crucial signals for whether today's risk-off episodes remain contained or morph into something more systemic. Stepping back across assets, the picture is one of growing tension between solid global earnings and AI-driven growth on one side, and mounting stress in private credit, stickier near-term inflation, and rising geopolitical risk on the other. Equities are no longer a simple U.S. megacap story, with value, infrastructure, and international markets taking more of the leadership even as headline indices wobble. Government bonds have regained their safe haven role. Credit is forcing a deeper conversation about liquidity and transparency. The dollar remains the system's anchor despite diversification talk, and oil and gold are quietly marking out the range of plausible geopolitical outcomes. For cross-asset allocators, the important signposts now are incoming inflation and labor data for the policy path, developments in private credit and bank funding, and any change in the Iran risk premium embedded in energy and FX. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.